Pepsi is cutting its profit forecast for the year, citing tariffs and weaker consumer demand.
So Pepsi, there was some good beat, revenue growth, gross margins expanded. The stock is reacting with a 2% down arrow.
Pepsi's at about 10% and Coke is about at 20%. So Coke is the better margin producing company.
Coca-Cola, and it's got a major announcement.
It will begin using real cane sugar in the United States.
What if your grocery list from 20 years ago was secretly a stock-picking cheat sheet? Imagine you'd invested $1,000 into the companies that fill your pantry, the titans of taste that dominate supermarket aisles. Well, we decided to find out. We're pitting three of the biggest consumer giants, PepsiCo, Coca-Cola, and Nestle, in a head-to-head investment battle. We didn't just glance at stock prices, we went back 2 decades, crunched the numbers, and reinvested every single dividend. The results were not what we expected. For a long time, one company pulled ahead, creating a massive lead. But as the years went on, the race got much, much closer. The story of how this rivalry has played out holds some powerful lessons for every investor. Welcome to the ultimate investment showdown. First up, you have the undisputed king of cola, a brand so powerful it's practically a global currency, the Coca-Cola Company. It's the definition of a blue chip stock, a dividend king that has been paying shareholders for generations.
This is a real bottle with the real product, sweetened by cane sugar.
The Coca-Cola you're used to is sweetened with high fructose corn syrup.
In the second corner, its eternal rival, a company that's so much more than soda, PepsiCo. With a massive global snacks business, including giants like Lay's and Doritos, it's a diversified food and beverage powerhouse. And our third contender, hailing from Switzerland, is the largest food company in the world, Nestlé. With a portfolio that stretches from coffee and water to pet care and health science, it's a universe of brands all on its own. These aren't just companies, they're empires. They are classic defensive stocks, selling things people buy whether the economy is booming or busting. This resilience makes them a cornerstone for many long-term investors. But the real question is, if you had to bet on just one for the long haul, which would have made you the most money? Section 1, the $1,000 challenge, setting the stage. Here's how our experiment works. We're hopping in a time machine back to the summer of 2005. We're taking $1,000 of imaginary cash and investing it into each of these three giants, PepsiCo, PEP, Coca-Cola, KO, and Nestlé, NSRGY. But this isn't just about watching the stock price. To really see the power of these investments, we have to include the secret weapon of long-term wealth: dividends. All three of these companies are famous for sharing their profits with stockholders, and we are going to reinvest every penny of those payments back into buying more stock. This is called dividend reinvesting, and it's how you get your money working for you. It creates a compounding snowball effect where your dividends start earning their own dividends, accelerating your growth over time. For mature, stable companies like these, dividends are a huge piece of the total return puzzle. So the stage is set. 3 $1,000 investments, 2 decades of market chaos, every dividend reinvested. By the end, we'll see which company came out on top, and the results might just change how you look at the brands in your fridge. Section 2, head-to-head, revenue and business diversification. Before we get to the final scoreboard, we need to understand how these companies actually make their money. And right away, the story gets interesting. First, Coca-Cola. It's a pure-play beverage giant. Its entire world revolves around selling drinks, and its massive revenue is a testament to incredible brand power and a distribution network that reaches virtually every corner of the earth. Then you have PepsiCo. You'd think their revenue would be similar, but it's not even close. PepsiCo's revenue is significantly larger, often more than double Coca-Cola's. How? The answer isn't in the drink aisle, it's in the snack aisle. A huge chunk of PepsiCo's revenue, around 55% to 58%, comes from its food division. Brands like Lay's, Doritos, and Quaker are part of a snacks empire that gives PepsiCo a massive revenue edge. This makes it a fundamentally different beast. It's a diversified food and beverage company, which gives it incredible resilience. If drink sales are slow, the snack business can often pick up the slack. And then there's Nestlé. The Swiss giant is on another level entirely. With revenues that approach $100 billion, it's the largest food company on the planet. Its business is a masterclass in diversification. Its biggest segment is powdered and liquid beverages, including Nescafé and Nespresso, but that's just for starters. Nestlé is also a world leader in pet care with Purina, a major player in health science, and a powerhouse in prepared meals, candy, and water. Owning Nestlé is almost like buying an ETF of global consumer brands. So, when it comes to sheer size, Nestlé is the king. But PepsiCo's dual threat of snacks and drinks gives it a unique and powerful model that lets it blow past its old rival Coca-Cola in total sales. This difference is key to understanding how they've performed over the years. Section 3. Head-to-head, profitability, and margins. Bringing in a ton of revenue is great, but how much of that money do you actually keep as profit? This is where the story flips and Coca-Cola starts to look like a champion. Despite having way less revenue than PepsiCo, Coca-Cola has historically run with incredibly high profit margins. Coke's net margins can be in the mid-20% range, while PepsiCo's are often about half that. That means for every dollar in sales, Coke keeps a much bigger piece of the pie. How do they pull this off? Their business model is genius. The company mostly just sells beverage, concentrates, and syrups to its bottling partners around the world. This franchise model means Coke avoids the enormous costs of manufacturing, bottling, and distribution. It outsources the hard, low-margin work, allowing it to stay a lean, mean, high-margin machine. Its brand also gives it immense pricing power. PepsiCo, on the other hand, runs a much more complex and expensive show. Managing a global snack business means dealing with farms, factories, and a massive delivery network. While it's very profitable, the snack business just doesn't have the sky-high margins of selling syrup concentrate. That's the trade-off for all that revenue diversification. Bigger sales, but a smaller profit percentage. Nestlé, with its sprawling empire, has solid margins that vary by product. Segments like Nespresso and health science can be highly profitable, but managing a supply chain for everything from pet food to frozen pizza is a massive undertaking that keeps its overall margins from reaching Coca-Cola's levels. So, in the battle of profitability, Coca-Cola is the clear winner. Its asset-light, high-margin model is why investors have loved the stock for decades. It's a cash-generating machine. Section 4. The Dividend Deep Dive. For long-term investors, dividends aren't just a nice bonus. They're the main event. This is the cash you get paid just for owning a piece of the company. Let's see how our contenders compare on yield, growth, and safety. First, dividend yield, the immediate income you get. As of mid-2025, they all look pretty good. Coca-Cola's yield is around 2.9%. PepsiCo often has a higher yield, recently sitting around 3.8% or 3.9%. Nestlé also offers a strong yield, which can be over 3.2% and has recently been as high as 3.9%. On this front, PepsiCo and Nestlé often give you a bit more cash up front. Next, and maybe more important, is dividend growth. A dividend that's consistently going up is a sign of a healthy company. Here, we see a fascinating race. Both Coca-Cola and PepsiCo are Dividend Kings, an exclusive club of companies that have increased their dividends for over 50 years in a row. An incredible track record. But if you look at the speed of that growth, PepsiCo has often had the edge. Over the last 5 years, PepsiCo's dividend has grown much faster, averaging around 7% growth annually compared to Coke's 4 to 5%. So while Coke offers legendary stability, PepsiCo has been giving its investors a bigger raise. Nestlé also has a solid history of dividend growth, though it can be affected by currency changes since it's paid in Swiss francs. Finally, there's safety, which we can check with the payout ratio. This tells us what percentage of profits are used to pay the dividend. Coca-Cola's payout ratio is often in the 70% range, which is high but sustainable for such a stable business. PepsiCo's can also be high, sometimes in a similar range to Coke's or even higher, which is something investors keep a close eye on. Nestlé's payout ratio is typically considered sustainable, sitting in a range similar to Coca-Cola's. So what's the verdict? It depends on your goal. Coca-Cola is legendary for its stability. Nestlé offers a strong yield with global diversification. But if you're a dividend growth investor, PepsiCo has been the more aggressive player, consistently delivering bigger raises to its shareholders. We're about to get to the most exciting part, the grand reveal of our 20-year, $1,000 investment showdown. The final numbers are in, and the story is fascinating. But before we reveal which company would have made you the most money, if you're finding this breakdown valuable, do me a favor and hit that subscribe button. We do data-driven analysis like this all the time to help you become a smarter investor. And drop a comment below with which stock you think is the long-term winner. Let's see who gets it right. Section 5, the grand reveal, the 20-year total return. We've looked at their businesses, their profits, and their dividends. Now it's time to answer the big question. Which company delivered the best performance for investors? Let's go back to August 2005. We invested a hypothetical $1,000 into Coca-Cola, PepsiCo, and Nestle. We held on through thick and thin, and most importantly, we reinvested every dividend to let compounding work its magic for 2 decades. Let's start with our third place finisher. An investment in the Swiss giant, Nestlé, would have provided a fortress of stability. However, in terms of total return over this period, it lagged its 2 main rivals. For much of the past 20 years, the story had a very clear leader. An investment in PepsiCo would have performed phenomenally. That initial $1,000 with dividends reinvested would have compounded at an impressive rate, historically outpacing both of its competitors over long stretches. For years, PepsiCo was the undisputed champion of this showdown. But here's where the story gets a twist. While PepsiCo dominated for a long time, the race has gotten incredibly tight in the last decade. Coming in first place, by a nose, is Coca-Cola. While PepsiCo outperformed for much of the 20-year period, a stronger performance from Coca-Cola in more recent years has allowed it to catch up and, by some measures, even pull ahead in total return over the last 10-year period. For example, some recent data shows Coca-Cola delivering an annualized return of around 8.89% over the last 10 years, compared to PepsiCo's 7.31%. So while PepsiCo gave investors a massive head start, Coca-Cola has closed the gap. Section 6, the why, deconstructing the rivalry. So what happened here? Why did PepsiCo build such a commanding lead for so long, and how did Coca-Cola fight its way back into a photo finish? PepsiCo's early dominance came from one brilliant move, its diversification into snack foods. While Coca-Cola was fighting the war on sugar, PepsiCo had a second empire with Frito-Lay that was its growth engine. As people grew more health conscious about soda, they kept on snacking. This dual threat model gave PepsiCo incredible resilience and a powerful second growth driver. That faster growth also fueled faster dividend growth. As we saw, PepsiCo has consistently given shareholders a bigger annual raise. When you reinvest those bigger dividends over 2 decades, it acts like a massive accelerator for your total return, which is how it built its lead. So why the comeback from Coca-Cola? While its growth was slower, its high-margin business model remained a cash-generating juggernaut. In recent years, as PepsiCo's growth has faced its own challenges, Coke's stability and incredible brand power have shown through, allowing it to deliver strong, steady returns that have closed the gap. This isn't a simple story of one winner, it's a story of 2 different strategies, where the leader has changed depending on the decade you're looking at. Section 7, Future Outlook. Which stock for tomorrow? The past is a great teacher, but we invest for the future. Looking at 2025 and beyond, which of these giants looks best positioned? Coca-Cola's future depends on pushing beyond its classic brands. It's making moves in coffee with Costa, sports drinks, and zero sugar options. That incredible brand power and high margin model will always make it a top-tier defensive pick. For a conservative investor focused on stable income and brand strength, Coke is hard to bet against. Nestlé is betting big on health and wellness. It's a leader in nutrition science, plant-based foods, and premium coffee, all major long-term growth trends. Its massive global diversification is a huge plus in an uncertain world. For an investor who wants a truly global, defensive cornerstone for their portfolio, Nestlé is incredibly compelling. And what about PepsiCo? It continues to lean on its strengths. It's innovating with healthier snacks and pushing into new beverage categories. Its challenge is managing its complex operations and navigating consumer shifts away from processed foods. But for investors who believe in its balanced model of snacks and drinks and want a mix of income and growth, PepsiCo still makes a powerful case. Ultimately, the best stock for you depends on what you're looking for. Do you want the highest margins and brand purity, Coca-Cola, unmatched global diversification, Nestlé, or a proven model of balanced growth across two resilient sectors, PepsiCo? After a data-driven showdown, the results of our 20-year, $1,000 challenge are more fascinating than we imagined. There wasn't one clear winner who held the crown for the entire period. PepsiCo shot out to a huge lead for years, powered by its genius move into snacks and aggressive dividend growth. But Coca-Cola, the icon of stability, showed incredible resilience, closing the gap in recent years to make it a true photo finish. The biggest lesson here is that a company's strategy matters more than just its name. PepsiCo's victory for much of this period wasn't about beating Coke at its own game. It was about creating a better, more resilient one. Yet Coke's simple, high-margin model proved its own timeless value. All three of these companies are pillars of the global economy and will likely keep rewarding shareholders for years to come. But our analysis shows that the title of best investment can change hands over time. So, which company would you bet on for the next 20 years? Let me know your pick and why in the comments below. And if you enjoyed this breakdown, make sure to like and subscribe for more deep dives. Thanks for watching.